My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends, just trying to make you some money. My job, not just to entertain you, but to educate and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. This is a macro market where stocks go up or down based on the strength of the overall economy, and the performance of individual companies, called the microeconomy, is often lost in the shuffle. But how the heck do we predict where the economy is headed? If you're a money manager, you've been taught pretty much from day one, as I was, to watch the bond market for clues about where stocks are going. Now, I'm always pointing out that the bond market, which I know is incredibly boring, that the bond market's much larger than the stock market. More important, bond yields are tells. That means they can tell you, say, when stocks are overpriced. Which brings me to today's session. You couldn't tell from the averages, with the Dow inching up 54 points, S&P declining 0.33%, 0.33, and the Nasdaq losing 0.70%. But for many stocks, today was absolutely hideous.
The House of Pain.
At the same time, it was a glorious day for bond prices, which rallied again, cutting their yields even more dramatically. You know, the benchmark 10-year Treasury bond currently pays 1.3%. Oh, you don't want to buy that. When you see that kind of action in Treasuries, it's supposed to be a real bad sign for the economy. There's just one nagging problem. What the bond market's saying right now doesn't seem to make much sense to many people, including me. There are discordant voices out that they're pointing out that bonds don't seem to be functioning as a predictor of the broader economy anymore. If they were, rates would be going up, not down, because we know inflation's raging right now and business is getting stronger. Worse, many investors listened to Fed Chief Jay Powell's 2 days of testimony on the Hill and came away feeling like he's simply out of touch. He keeps saying that inflation's transitory, but they're convinced everything's going up in price, especially labor, the kind of inflation businesses most fear. So we have to ask, who's right? Is it the bond market or the inflation numbers and the growth numbers? And more importantly, what does that mean for stocks in your portfolio? Are the stocks that are getting crushed an opportunity? Or are they fool's gold? First, I've been in this business long enough to know that you don't quibble with the bond market. I take what it says loud and clear because historically when I've gone against it, it hasn't worked out well for me. Not always, but most of the time. Right now, though, there is a real conundrum, and it's putting major pressure on many stocks, especially the speculative high-growth names that have profited ever since younger people got into the stock market more than a year ago. Let's go over the theories that explain the action in the bond market. Again, I'm trying not to bore you, I know, okay? And I'm also not going to get political. I don't do that, okay? Theory one, it's possible that our bond yields are plummeting simply because U.S. bonds offer better risk-free returns than bonds for anywhere else in the world. All sorts of countries issue bonds. This is important. Worldwide, there are trillions of dollars constantly searching for the highest quality, most liquid, and highest yielding pieces of paper. Believe it or not, right now, that's U.S. Treasuries. You can go in and out of billions of dollars. That's liquidity. So it's entirely possible that the action in the bond market means absolutely nothing because our rates are better than most countries. Under this theory, well, what are bonds? Well, they're a tale told by an idiot full of sound and fury signifying nothing. Okay? If that's true, then the higher yielding dividend stocks deserve to go higher. Remember, I told you Clorox is bottoming you. You can think about Kimberly, Procter, PepsiCo's going up. And for everything else, there's really no impact whatsoever. Theory two, bonds may be going up in price, down in yield, because Jay Powell is absolutely right when he says that our current bout of inflation is merely temporary. We got a red-hot CPI number this week, but the key components, used cars, foodstuffs, energy, they may all be collapsing at once. I called the top in oil today. Well, it's an attempted call top, right? I mean, it may still go up, but I think I smell it. I smell it. It's too high. Wage inflation, I think, should moderate once the extra unemployment benefits expire at the end of the summer and more people come out looking for jobs. Now, if this theory is correct, it would be incredibly bullish bullish for stocks. However, if that were really true, you'd expect the turbocharged growth stocks to roar because they thrive in a low inflation environment. Instead, they got obliterated. So stocks are saying this view is definitely wrong. Theory 3. There's always the chance that bond yields are falling because the economy's headed for a slowdown. Given that today we got the lowest jobless claims number since the pandemic began, I find that hard to believe. And by the way, the small business information we get shows that small business is incredibly strong. Wells Fargo told us over and over again how strong business is. Unless, of course, the Delta COVID variant ends up hitting everything, slowing business more than we realize. Possibility. No, I don't want to believe it. I don't want to believe that we're on the verge of putting masks back on or because people refuse to get vaccinated. Unfortunately, it is a possibility, a real possibility. If this is actually about the Delta variant, that explains why so many cyclical stocks that need a strong economy have been slaughtered. Those are the 3 scenarios, okay? Let's relate them to your portfolio. I believe the second one, the bond market's predicting that inflation's peaking, Jay Powell's correct, is right. But you know what? When it comes to trying to figure out things, it's not that my opinion doesn't matter. See, my job is to figure out what the big buyers and sellers are thinking, not what Jim Cramer's thinking. I know what I'm thinking. But if theory 2 is right, how do we explain the weakness in so many parts of this market, including areas that should be thriving in a peak inflation scenario? I think I have it. And it's none of those. None. Okay? I think right now we have a lot of speculation in the system. In part because the government's given away so much money, in part because there's a new cohort of investors, younger people who tend to borrow money to buy everything from Bitcoin, which is being crushed, by the way, to all sorts of high-growth stocks that they don't know the first thing about, and, of course, all this junk that they keep taking up that probably should be much lower. These younger investors seem drawn to technology, biotech, crypto, meme stocks, the latter being the unfortunate name for the stocks that have become playthings for the Reddit contingent that keeps trying to game the ungameable. I think these speculators are starting to get blown out. I knew it was going to happen eventually. After a prolonged period where they had an amazing run. In some ways, this stock market mirrors the slow-motion washout we're seeing in cryptocurrencies and the big meme names like AMC, which actually went up today, or GameStop, which rallied 8 points from its low to close down 80 cents. Frankly, I don't trust either of those things. GameStop's up 785%. AMC's up 1,598 points. Come on, enough. Just ring the register already. At the same time, we've had so many IPOs and SPAC deals that the supply of new stock is overwhelming the natural demand, especially since big money managers don't want these speculative stocks and the small investors don't have the conviction to buy more into weakness. Under that scenario, stocks just don't languish, they go down, especially the speculative stocks, the commodity-oriented names, and the recent IPO names that nobody cares about. So why exactly are stocks going down right now? Most people think the answer lies in the yield curve, that bonds are doing what bonds are doing. I get that. That's the way I was taught, too. But right now, no. We have an answer that can drive with theory. Number one, that bond yields are falling because foreign money's flowing in overseas, and it means nothing. It means nothing to do with the stock market. That's right. That's what's happening. Many stocks are getting hit here because there's not enough cash to buy all the junk that's been created of late. All the second-rate tech and biotech, something or other as a service place. Stocks are going down because just like the merchandise in the store, there's just too much inventory. So it's being marked down. Speculative ones are always the first to go. The underwriters are just not being vetted, and for the most part, the SPACs aren't worthy of your time or money. If the IPO spigot doesn't turn off, if more and more new stocks keep being pumped out, then it doesn't matter what the bond market says. Stocks will keep falling under their own weight, the smaller ones first. That's why FANG was the last to go down. What can turn things around? Bottom line, if we get a respite from new underwritings and the earnings trend continue to be good, then I remain a bull. Oh, but you got to stop the new supply, please. Hence the answer, stocks are going down because people need to sell. See, because they don't lose money.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.